Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
What if I told you there's an investment strategy that could legally help you pay less in taxes, and most people have never even heard of it?
Wait, really? Is this some kind of loophole, or are we talking about something legitimate?
It's not just legitimate, it's a sophisticated strategy used by high net worth investors for decades. We're talking about municipal bonds, the tax efficiency tool hiding in plain sight that could transform how everyday investors think about their portfolio.
Welcome back to our ongoing exploration of bonds. In this episode, we introduce the concept of municipal bonds as a tax-advantaged investment vehicle that often flies under the radar. Let's dive deeper into how these unique securities function and who might benefit most from including them in their portfolio.
Absolutely. Let me first explain what municipal bonds are. Municipal bonds are debt securities issued by state and local governments to fund public projects. The key feature that sets them apart is their tax treatment. Interest earned on municipal bonds is generally exempt from federal income tax and, in some cases, state and local taxes as well.
So, if I understand correctly, by investing in municipal bonds, I could potentially keep more of my investment returns by avoiding taxes on that income.
Precisely. This tax exemption makes municipal bonds particularly attractive for investors in higher tax brackets. The higher your tax rate, the more valuable that tax exemption becomes.
That's a powerful benefit. But as with any investment, there are likely some trade-offs to consider as well, right?
Definitely. The main trade-off with municipal bonds is that their yields are typically lower than comparable taxable bonds before considering the tax benefits. So investors need to do some math to determine if the tax savings outweigh the lower nominal returns.
What kind of math are we talking about here? How can I figure out if municipal bonds make sense for my situation?
Great question. The key calculation is something called the tax equivalent yield. Essentially, you're figuring out what a taxable bond would need to yield to provide the same after-tax return as a municipal bond.
Let's break that down with an example to make it more concrete.
Sure. Let's say you're considering a municipal bond yielding 4%, and you're in the 32% federal income tax bracket. To calculate the tax equivalent yield, you divide the municipal bond's yield by 1 minus your tax rate. So in this case, it would be 4% divided by 0.68, which equals about 5.9%.
So that means a taxable bond would need to yield around 5.9% to provide the same after-tax return as the 4% municipal bond for someone in the 32% tax bracket.
Exactly. This is why municipal bonds can be especially compelling for investors in higher tax brackets. The tax savings really add up.
That's a great insight. Now, are there any other factors investors should consider before adding municipal bonds to their portfolio?
While the tax benefits are a key feature, investors should also consider factors like their overall investment goals, risk tolerance, and how municipal bonds fit into their broader asset allocation strategy. It's also important to understand that certain municipal bonds, like those funding private activities, might face different tax rules.
It sounds like municipal bonds can be a valuable tool, but they're not necessarily a one-size-fits-all solution. Investors need to carefully evaluate their individual situation.
I think that's a key takeaway. Municipal bonds offer unique tax benefits that can be highly valuable for certain investors, particularly those in higher tax brackets or seeking tax-efficient income. But as with any investment decision, it's crucial to consider your personal circumstances and goals.
Well said. Municipal bonds can play an important role in a diversified portfolio, offering tax advantages, stability, and reliable income. But they're one tool in the toolbox. The key is understanding how they fit into your overall financial picture.
This has been a fascinating exploration of municipal bonds. We've covered a lot of ground, from the basics of how these securities function to the specific benefits and considerations for different types of investors.
Agreed. I feel like I have a much clearer understanding of when and why municipal bonds might make sense as part of an investment strategy.
Fantastic. And remember, if you're considering municipal bonds or any new investment, it's always wise to consult with a financial professional who can provide personalized guidance based on your unique circumstances. If you'd like personalized guidance, you can reach out to us at safesimplessound.com/contact.
Absolutely. The world of investing can be complex, but understanding key concepts like tax advantage securities can help you make more informed decisions about your financial future.
Building on our previous discussion about the tax advantages of municipal bonds, I'm curious to explore some of the other key benefits and considerations for investors. What else makes these securities unique?
Municipal bonds offer several compelling features beyond their tax treatment. One key benefit is their relative stability compared to other investments like stocks. Because munis are backed by government entities with the power to tax, they tend to be less volatile and offer more predictable returns.
So, municipal bonds could be a way to reduce overall portfolio risk, especially during periods of market turmoil.
Absolutely. While no investment is completely risk-free, municipal bonds have historically provided a degree of stability that can be valuable for investors looking to balance risk and return. They can serve as a counterweight to more volatile assets.
That's an important point. Diversification is a cornerstone of smart investing, and municipal bonds can play a key role in creating a well-rounded portfolio. But what about liquidity? Are municipal bonds easy to buy and sell?
That's a great question. Municipal bonds are generally less liquid than assets like stocks or treasuries. While there is a secondary market for munis, it's not as robust as some other markets. This means investors may face wider bid-ask spreads or difficulty finding a buyer if they need to sell before maturity.
So, liquidity is a potential trade-off to consider. Investors need to think about their time horizon and whether they're comfortable holding a bond to maturity.
Exactly. As with any investment decision, it's about weighing the pros and cons in light of your individual goals and constraints. Now, we've talked about some of the key benefits of municipal bonds, but what about the risks? What should investors be aware of?
One key risk to understand is credit risk, the possibility that the bond issuer could default on their payments. While defaults on municipal bonds are relatively rare, they can happen. This is why it's crucial for investors to research the creditworthiness of any bond issuer before investing.
How can investors gauge the creditworthiness of a municipal bond issuer? Are there ratings or other indicators to look for?
Yes, credit rating agencies like Moody's and Standard & Poor's assess the credit risk of municipal bond issuers and assign ratings. Generally, bonds rated BBB or higher by Standard & Poor's or BA or higher by Moody's are considered investment grade, indicating a lower risk of default. However, investors should still do their own due diligence and not rely solely on ratings.
That's sound advice. As with any investment, it's important to understand what you're buying and the associated risks. Now, for investors who are interested in exploring municipal bonds, what are some practical next steps?
A great first step is to consult with a financial professional who can help assess whether municipal bonds fit into your overall investment strategy. They can help you navigate the various options available and build a bond portfolio aligned with your goals.
And for those of us who like to be hands-on, are there resources available to research and compare different municipal bonds?
Absolutely. Investors can access a wealth of information through online platforms like the electronic Municipal Market Access website, which provides free access to official statements, trade data, and other information about virtually all municipal bonds. Many brokerages also offer research and screening tools for municipal bonds.
Those are great resources for investors looking to dive deeper. What would you say are the key takeaways about municipal bonds?
I think the main points are that municipal bonds can offer compelling tax advantages, particularly for investors in higher tax brackets, along with relative stability and predictable income. However, they also come with trade-offs like lower liquidity and potential credit risk. As with any investment, It's crucial to understand the features and risks and to consider how they fit into your overall financial plan.
That makes sense. It's about evaluating the specific benefits and drawbacks in light of your individual circumstances and goals.
Exactly. Municipal bonds can be a valuable tool in the right context, but they're not a one-size-fits-all solution. The key is to make informed decisions based on your unique financial situation. And if you're unsure, don't hesitate to seek professional guidance. Building on our previous discussion about the tax advantages of municipal bonds, let's explore some of the other key benefits and considerations for investors. What else makes these securities unique?
Municipal bonds offer several compelling features beyond their tax treatment. One key benefit is their relative stability compared to other investments like stocks. Because munis are backed by government entities with the power to tax, they tend to be less volatile and offer more predictable returns.
So, municipal bonds could be a good way to reduce overall portfolio risk, especially during periods of market turbulence. It seems like they provide some ballast.
Exactly. Municipal bonds can be a valuable tool in the right context, but they're not one-size-fits-all. The key is to make informed decisions based on your unique financial situation. And if you're unsure, seek professional guidance.
Well said. Munis are a sophisticated investment, but with the right understanding and approach, they can play a valuable role in many portfolios.
Thank you both for another enlightening discussion. To our listeners, we hope this exploration of municipal bonds has provided valuable insights for your own investment journey. Thanks for that comprehensive overview of the key benefits and considerations around municipal bonds. Building on that, let's dive a bit deeper into how munis actually work and the role they play in public finance. Can you walk us through the basics of how a municipal bond is structured?
Absolutely. At its core, a municipal bond is essentially a loan that an investor makes to a state or local government entity. The issuer uses the borrowed funds to finance public projects like building schools, highways, or sewer systems. In return, the issuer promises to pay the investor a specified amount of interest, usually semi-annually, and to return the face value of the bond upon maturity.
So it's fairly similar to how a corporate bond works, but the borrower is a government entity rather than a company, and the funds are used for public projects.
That's right. One key difference is that the interest on municipal bonds is usually exempt from federal income tax, and sometimes state and local taxes too, depending on the investor's residency. This tax exemption is a major draw for many muni investors.
Let's make this a bit more concrete. Can you give us a real-world example of how a municipal bond might be used to fund a public project?
Sure. Let's say your local school district needs to build a new high school. They could issue municipal bonds to raise the necessary funds. The school district would borrow money from investors by issuing bonds, use that money to build the school, and then pay interest to the bondholders over the life of the bonds, which could be 10, 20, or even 30 years. Upon maturity, the district would repay the face value of the bonds.
Okay, I think I'm starting to get a clearer picture. So by buying a municipal bond, an investor is essentially lending money to help fund public projects in their community or state, and in return, they receive tax-exempt interest payments.
Exactly. It's a way for local governments to raise funds for projects that serve the public good and for investors to earn tax-advantaged income by supporting those projects.
That's a great summary. And it's worth noting that municipal bonds come in many different flavors. Some are general obligation bonds, backed by the full faith and credit of the issuer. Others are revenue bonds, backed by specific revenue streams like highway tolls or utility fees. So investors have some choices in terms of the type of project they're funding and the source of repayment.
Thanks for clarifying that distinction. It's important for investors to understand what their bonds are funding and how they'll be repaid. Now, we've talked about the tax advantages of munis, but can you explain in a bit more detail how those tax savings actually work?
Gladly. The tax benefits of municipal bonds stem from the fact that the interest they pay is exempt from federal income tax. So if you're in, say, the 24% federal tax bracket and you earn $1,000 in interest from a corporate bond, you'd owe $240 in federal taxes on that income. But if that $1,000 in interest came from a municipal bond, you'd owe no federal tax.
And this tax exemption applies regardless of your tax bracket, right? So the higher your tax bracket, the more valuable the exemption becomes.
Precisely. The tax savings are most significant for investors in higher tax brackets. And if you buy bonds issued in your home state, you may also avoid state and local taxes on the interest, multiplying your tax savings.
That really shows how much of an impact the tax exemption can have, especially for those in higher brackets. A 4% muni yield might not sound impressive at first glance, but on a tax-equivalent basis, it's quite attractive.
That's a key point. Many investors underestimate the power of the tax exemption. They see a lower nominal yield and think munis are a worse deal. But you have to consider your after-tax return. For investors in high brackets, munis can often provide better after-tax income than taxable bonds with higher stated yields.
This is such an important concept for muni investors to grasp. The nominal yield is only part of the story. To truly compare apples to apples, you need to look at tax-equivalent yields based on your individual tax situation.
That makes sense. But I imagine there are some common misconceptions around the tax benefits of munis. What are some of the key things investors might misunderstand?
One common misconception is that all municipal bonds are completely tax-free. While the interest is usually exempt from federal taxes, there are some exceptions. For example, interest on some private activity bonds may be taxable or subject to the alternative minimum tax. It's important to understand the specific tax treatment of any bond you're considering.
That's a crucial distinction. Not all munis provide the same tax benefits. Investors need to do their homework and understand what they're buying.
Absolutely. Another misconception is that the tax benefits make munis a better choice than taxable bonds in all cases. But that's not necessarily true. For investors in lower tax brackets, the tax exemption may not be enough to offset the lower nominal yields of munis. It really depends on your individual tax situation.
So investors really need to crunch the numbers based on their own circumstances to see if munis make sense for them. It's not a one-size-fits-all proposition.
Exactly. Munis can be a powerful tool for the right investor, but they're not the optimal choice for everyone. It's all about understanding your tax situation and investment goals and doing the math to compare your options on an after-tax basis.
That's great advice, and it underscores the importance of working with a knowledgeable financial advisor who can help you navigate these complexities and determine if munis belong in your portfolio. On that note, let's do a quick learning checkpoint. Can you summarize for us the key things an investor should understand about the tax benefits of municipal bonds?
Sure. First, the interest on municipal bonds is generally exempt from federal income tax and may also be exempt from state and local taxes for in-state investors. Second, the higher your tax bracket, the more valuable this exemption becomes. You can calculate the tax equivalent yield to compare munis to taxable bonds on an apples-to-apples basis. But not all munis provide the same tax benefits, so it's crucial to understand the specific tax treatment of any bond you're considering. And finally, while the tax advantages are powerful, they don't make munis the right choice for every investor. It depends on your individual tax situation and investment goals.
That's a fantastic summary. You've really captured the key points about the tax advantages of munis and the important considerations for investors.
What types of investors are munis best suited for?
Great question. Municipal bonds tend to be particularly attractive for certain types of investors. Can you share some insights on who is typically drawn to munis and why they might be a good fit?
Absolutely. Municipal bonds are often especially appealing to high net worth individuals and those in higher tax brackets. Because the interest on munis is tax exempt, the tax savings are most significant for those paying higher marginal tax rates. A high earner in, say, the 37% federal bracket plus a high tax state like California could conceivably be facing a combined marginal rate over 50%. For them, the ability to earn tax-exempt income is hugely valuable.
That makes sense. The higher your tax rate, the more you save from that exemption, and the more attractive munis become relative to taxable bonds. But are there other reasons beyond the tax benefits that high net worth investors might favor munis?
Yes, wealthy investors also often appreciate the stability and predictability of municipal bonds. Many are looking to preserve their wealth while generating steady income. Munis can provide that reliable income stream with generally lower volatility than stocks and many other bonds. For investors who have already built significant wealth, capital preservation and dependable income often take priority over growth.
So, for high net worth individuals, munis can be a way to generate tax efficient income, reduce portfolio volatility, and preserve capital. That's a compelling combination. Are there other types of investors who are typically drawn to municipal bonds?
Definitely. Conservative investors of all stripes often gravitate to munis, regardless of tax bracket. Older investors nearing or in retirement frequently seek the stability and income of munis. Investors with lower risk tolerances who still need or want investment income also find munis appealing. The same goes for those who simply prioritize capital preservation over growth.
It sounds like the common threads are a focus on stability, income, and capital preservation over growth. Munis seem well suited for investors who have a slow and steady approach or who are more concerned with avoiding losses than maximizing gains.
Exactly. And that risk averse, income oriented mindset is common in retirement. So, munis are often a staple of retirement portfolios, where the priority is generating reliable income to fund living expenses while protecting against major drawdowns.
That's a helpful perspective. It really highlights how an investor's goals and stage of life can influence whether munis are a good fit. For retirees or near retirees focused on income and stability, munis can be a natural choice. But let's also consider a counterexample. What types of investors might munis not be as well suited for?
It's important to note here that although municipal bond interest generally isn't subject to federal taxes, the IRS does include income from such bonds in your modified AGI when determining how much of your Social Security benefit is taxable. Further discussion of this impact on Social Security taxation will be in future episode.
Oh, I didn't know that. We'll look forward to learning more about municipal bonds and Social Security tax interaction.
Sure. For now, as a general guideline, munis are generally less appealing for investors with a higher risk tolerance and a focus on growth rather than income. Younger investors in their peak earning years, for instance, might prioritize capital appreciation over current income and be comfortable with more volatility in pursuit of higher returns. They may be better served by stocks or higher yielding corporate bonds.
That's a good point. If you're in a lower tax bracket, have a long time horizon, and are aiming to maximize long-term growth, the tax benefits and stability of munis might not be as compelling. You might be willing to accept more short-term volatility for the chance at higher returns.
Agreed. The trade-off between risk and return is different for every investor. Those who are more aggressive and growth-oriented may find better opportunities elsewhere, while those who prioritize stability and income gravitate to munis.
This is such an important consideration. Investing is never one size fits all, and that's especially true with munis. Their unique attributes make them incredibly valuable for some investors and less optimal for others. It really comes down to each individual's financial situation, goals, and risk tolerance.
Definitely. And it seems like even for investors who could benefit from munis, it's about finding the right balance within a diversified portfolio. Munis can be a valuable tool, but they're not the whole toolbox.
Absolutely, no single investment, however attractive, should dominate your portfolio. The key is understanding how each piece, including munis, fits into your overall financial puzzle. And that's where working with a knowledgeable advisor who understands your specific situation can be so valuable.
I think that's the perfect note to wrap up on. Municipal bonds offer distinct advantages that make them uniquely well suited for certain investors. But ultimately, the decision to invest in munis should be part of a comprehensive financial plan that takes your full situation and objectives into account. As with any investment, it's about understanding both the benefits and the trade-offs and determining how munis might fit into your individual strategy. Thanks to both of you for this illuminating discussion.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at savesimple.sound.com/contact. Until next time, take care and bye for now.